Hey, so why are so many income investors quietly losing money in these funds? Like they're not even realizing it, right? So I'm gonna show you exactly what is happening inside these covered call ETFs, and then I'm going to show you a tool that lets you compare them side by side with your own DIY strategy. So you can make this decision with actual data, not a headline. Okay. Yeah, just stick around because at this end of this, because at the end of this, you will know one number, one single metric that tells you whether a covered call ETF is compounding your wealth or just handing your own money back to you in a month checks, right? So let's start with the uncomfortable truth. A QYLD has advertised yields like above 10% per year, right? But if you would have invested like $10,000 in QYLD at launch and reinvested every distributions, here what your accounts look like. Um, and meanwhile, the QQQ, um, the index QYLD is supposed to generate income from has done, right? That's a gap. That's not a tax issue, right? That's not a bad luck. That's the structure of the fund working exactly as decided. And it's costing income investors thousands of dollars. Um, so here one of the distribution yield tells that how much cash you are funding, right? Um, like what exactly wealth you're building. Like if you have like 10,000 invested in QLD launch, 3-year total return is like QLD 6%, XYLD 18%, JP 13%, 31%, and if you would have done like DIY wheel, it could have like 74%, and then QQQ index is like 89%. So four funds, they're like totally a different structure. So let's walk through the four biggest covered call ETFs, not just the yield, what actually under the hood, right? So QILD sells at the money covered call on Nasdaq every month, at the money that collects maximum premium, which is why the yields look so high. But it also gives up like 100%, right? Of the upside of zero. So in a bull market, QILD is structurally designed to underperform. This is not a bug for information, it is a trade-off. For XMLD, same structure on the S&P 500, less volatility, lower yield, but the same logic applies. So you can see like 8.4%, 3-year total return 18%, and premium capture is like 48, expense ratio 0.60. So I basically add the money calls. Now let's see JP. Um, More interesting, instead of writing covered call directly, it uses equity linked notes, ELNs we call, on S&P 500 stocks and holds a more defensive equity portfolio underneath. That structure means it is participates more in equity gains than QILD does, and while still generating income, right? So the yield is lower, around 6 to 8%, but the total return profile is much better, right? Now let's focus on the JPQ. JP is JPQ. The last one is basically a Nasdaq focused sibling. Same ELN structure, higher yield because Nasdaq options carry more premium, more upside capture than QLD because it's not selling at the money calls. So you can say like it's not selling at the money calls, right? Um, so point to premium capture ratio column, the number right here, right? The premium capture ratio, you can see like the premium capture ratio for everything, all the four funds, is the one I want you to remember because it tells you efficiently each fund is monetizing the options premium relative to what's theoretically available. JP and JPQ tend to score better here. That's one reason their total return profiles looks different, right? So So four firms, very different structure. Let's come to the slide three. Bull versus bear, basically. So now here the questions, the most video never asked, like most people don't say, they don't bother. Like, should you even be in these ETFs, or would you be better off running your own covered call strategy, right? Um, so this is where the secure put calls does something which I haven't seen any other tool. It lets you compare the covered call ETF returns directly against what you would have earned the wheel strategy yourself on the same stocks. So let's see the SecurePutCalls.com. Let's see what it does, right? So there's, if you go into SecurePutCalls.com, it is something um, which have like various tools. So let's directly jump into the covered call ETF tool. Yeah, this one. So if you see, if you just invested like $10,000 and you're holding for like 12 months, um, you can see like JP and QYLD and MSUI and XYLD, like what is the net return, and what how the expense ratio is. You know, so look at the same capital, same time period, same underlying equities. The DIY wheel strategy generates a high total return and comparable uh, monthly income, because when you run your own covered calls, you keep like 100% of premium, right? No fund overhead, no management fees, no middleman. So now, and this is important, I'm not saying the ETFs are bad, but if you don't want to manage individual positions, if you are investing in a retirement account, if you want exposure without the time commitment, covered call ETFs are a legitimate, low maintenance alternative. The point is choose with data, right? No assumption. So you can see like the comparison is very clear. The net return is like 332 here for JP, and for MSCI 894, and will return like 8.95%. And then you see like NAV analysis, you can clearly see, it's like 43.9% annual, but it depends, right? So um, now, so we have to decide, right? We have to decide, right? So like ETF versus DIY wheel strategy. So why? I mean, you can see like the by DIY, by doing like your own wheel strategy, you have like much better return, because there is no middleman, as I said, and there is nothing to hide, right? So um, now you can three question, right? Three question before you ask, right? Like uh, what basically you're gonna do you're going to do. So do you have to do you have to manage your own, do you have like time to manage your own YouTube own option positions? Do you have to like watch your own YouTube videos always to get the guidelines, that what I do and what I don't have to do, right? So uh, this is, if yes, like if you have time to manage your own individual positions, then yeah, just do wheel strategy, right? DIY. Why not? Why you are going to cover call ITF, right? So question number two, like, am I in a taxable account? Like, if yes, like Roth IRA, uh, if you have retirement account like Roth IRA, then ETF is more competitive here. And if it's a taxable ETF distribution, tax like ordinary income, right? So DIY can be more tax efficient. So question number three, what market environment do I expect? So high volatile, sideways bear, ETF premium cushion. Always there is a shine. There is a way to go. It's a more competitive, and If it's a strong bull market, upside cap is always like very closely and very costly, and DIY like significantly like it's outperformed. So what you what you gonna do, that you have to decide, right? So this is a very simple comparison tool, because the covered call ETF is like this whole space is like genuinely like very interesting. And JP and JPQ in particular have done a better job than most people give them credit for, but they're not substitute for understanding what you own, right? So that secure put covered call ETF analysis tool is totally free, and you can compare fund, you can run your own comparison, and yeah, you can request them to add your ETFs. Right now, it's like it's containing these two ETFs, and then you can filter by ETF, like the market regime. And if you want to go to the if you want to go further, basically the wheel screener is one of the tool. Um, so this is the way how wheel screener work. Like what is the algorithm behind that? You can hide that info. So this screen is like every day. It just run like around 10:30 a.m. in the morning EST time. So next scan, you can see like it's after 11 hour. Um, so you can see like what is the stock which is strike is good for my wheel. What are these? What is the risk factor? Um, you can say like all the risk gamma squeeze is there, no, or there is any standard risk there, circular trading risk any, so this is all proprietary tools, and every morning around 10:30, 10:45, you can see like what is exactly coming, and then you can take a wheel, right? So yeah, there is no credit card required. It's a free tool. It's all like watch what return, what is good, what is the liquidity level, everything you can see here. If this was useful, just subscribe to the channel. I cover basically income trading, wheel strategy setups, and data driven approaches to generate consistent returns. Drop a comment below. Are you in a covered call ETF right now or running the wheel yourself? Just put comment and let me know what do you think. Yep. Thank you.